How about the action yesterday? What does it mean? What did it tell you?
So what yesterday was starting to price in the recession, the actual recession, not the fear of recession, but the actual recession driven by lower inflation expectations, a collapse of oil investment in this country, and really the fear of where this is going in the real economy on the demand side. So before we had the supply shock problem, and now we have the demand problem as schools close and municipalities start to really curtail what people are doing.
Some are arguing the markets is overplaying that thesis because we don't know what the stimulus response is going to be.
Look, the announcement from the White House yesterday and the suggestion there might be some action with Congress would be extraordinarily helpful here on the sentiment side. I suspect this is part of the process of bottoming and not the bottom, meaning we're going to have a lot of chop here. There's a lot of chop because the news is not all out. We discussed this before. Like, there's a lot of bad news still in front of us, and so you're going to see chop. Yesterday's bottom was a reasonable place to go if you look at all the technical levels. But we also went through some technical levels as well. So you have to start pricing in. If we have a recession and if we have a 15% earnings decline, where's the rational place for the market to be? And it's lower than yesterday's low.
David, for the moment, are you getting enough talk of stimulus from the federal government, the president, and the Federal Reserve to feel more comfortable about this market?
Well, I think, excuse me, I think so. I think I would take a slightly different interpretation of the price action. I mean, the bond market price action to me was really pricing in a move to the zero lower bound, that the Fed is going to be at zero with a very high probability in the next maybe 3 to 5 weeks, maybe even sooner. Certainly, I'd say after the March meeting, there's a really good probability of that with another intermediate cut if things get worse. And the stock market is sort of not really, doesn't know how to exactly deal with that, because if there is an aggressive stimulus coming in and an aggressive response from the Fed, and we get fiscal responses like something in small business lending, something in tax cuts, then we might be able to skirt through this, and the S&P can kind of flirt around with this 3,000 area and not have to go down to 2,500 or 2,300, which would probably be much more consistent with a recession area. So I'm not sure that I interpret this as pricing in a recession. I think what Monday was about is really sort of almost front-running Fed policy and thinking about the Fed coming on board quickly.
Well, it's funny you say that, because as we're talking, here comes the president. Our pathetic, slow-moving Federal Reserve, headed by Jay Powell, who raised rates too fast and lowered too late, should get our Fed rate down to the level of our competitor nations. They now have as much as a 2-point advantage with even bigger currency help, also stimulate. And then adds, the Federal Reserve must be a leader, not a very late follower, which it has been. We're going to see how Powell responds to that next week.
Yeah, look, if you have more days like yesterday, you'll have another immediate response and not wait till March 18th. But I would just say, to David's point, the other thing that was being priced in yesterday was the fear of negative yields here. I'm not saying it's going there. However, with such a rapid movement in yields and such a rapid decline in sentiment and expectations that we're going to the zero bound here, you could see the fear of negative yields. That's why the banking sector collapsed yesterday. That's why you had moves like that, because they're pricing in what happened to Europe as a result of negative yields. Not saying we're going there, but there's a fear out there that we could get there.
I think the question has sort of moved on, David, which is, can the Fed actually do anything to help this problem? I mean, we saw the 50 basis point cut. We see the markets pricing in extreme more cuts. We saw the Fed injecting more liquidity into the repo market and sort of easing rules on lending. What else can the Fed do to help the economy if it's paralyzed in fear about a coronavirus?
Well, I mean, I think, look, we still have a 1 to 1.25% funds rate, and we have no risk of inflation. We just saw the oil market collapse in an epic way, the second largest in modern history. We're going to have pretty big disinflationary forces hit this economy. The idea that the Fed is trading off some sort of inflation risk with a monetary easing worry makes no sense here. Not to mention that the other sort of trade-off is financial instability, meaning they create bubbles, and we're pretty far away from bubble creation after what we've seen in the stock market over the last few weeks. So there's not a lot of excuses for them to sit here, and I'm somewhat sympathetic to what the president's tweet said, and I think they're actually, independent of politics, I think they're probably on board with that the idea is that the rates don't need to be here. And Sarah, I do think it's not going to cure viruses or cure anything, but it is going to ease financial conditions. I think John Williams has said that. Jay Powell said that. They're just trying to ease a tightening in financial conditions. You guys have seen what's happened in the high yield market. You know there's no new issue market. It's shut. You know the secondary spreads have blown out very aggressively. We're up 8 to 10 points down in the HYG. Secondary trading is really difficult to get get liquidity
well, your firm
in.
knows that well. Of course, Jefferies obviously important in those markets, David, so I know you know them well.
Yeah.
But it's only right now. I mean, it doesn't necessarily mean it's going to extend for a long period of time. What about this argument that says the Fed should be preserving something for when and if we do actually have a recession?
I never understand that, because we know that last time we took the balance sheet from $800 billion to $4.6 trillion doing QE in a 1, 2, 3 step. And every Federal Reserve official that was part of that says we should have probably done a little bit more, a little bit faster. That's kind of the lesson of the last 10 years in the crisis. So they've got ammo coming out of their ears, as far as I'm concerned. The balance sheet of the Fed is something like 20 to 22% of GDP. In Europe, it's 35 or 40. In Japan, it's over 100%. We could expand this balance sheet and add a ton of liquidity into the system tomorrow if they wanted to do it. And I think that would have a very large impact on financial conditions, and it would have a very large impact on asset prices. Will it stop the virus? Will it stop some of the contagion that we're seeing on the ground? No, but it will ease a lot of the financial condition pain that comes from it, and that's important.